Now, if you're looking to trade the SPY, you're looking to trade the Qs, any equities as far as Nvidia, Tesla, Apple, whatever it may be, our focus has to always remain the indexes. And the underlying issue that I see most of the time is people focused on shorter term aspects. And that's the focus of today's video, is taking a step back and understanding the underlying trend of how we're moving and understanding market structure. That's what we're going to be diving into today. Now, before we get into any of that content, I have to ask you to do two things. Consider liking and subscribing. Every single day I make videos for you. And then on Saturdays, I make an educational video breaking down how I trade, why I trade, and giving you a better understanding, hopefully based on your request. So if you have a request for a video on Saturday that you would like to see make an educational video, comment down below. Let's get to it. Now, this is what I want to talk about first before we just dive straight heavy into this. Let's understand what market structure is. This is from our lesson. We have this like in the back catalog. I don't really have a course or anything, but I just want to show this really quick. We're not going to go through a PowerPoint or anything like that. What is market structure? And this is how I identify it, okay? Market structure is the behavior, condition, or current flow of the market. An example, this could be the market showing any of the following: higher lows, lower lows, double bottom, double top, new or old swing pivot highs or lows, etc. Now, the main purpose of market structure is used to spot the underlying movement of the market, which helps traders, specifically us, pinpoint clear direction for our trades. Understanding this current market structure is crucial for a trader and ensures they are putting themselves in the best position to win, specifically risk to reward. Now, risk to reward is the foundation of everything we do here. If you're new to the channel, you're gonna hear me say risk to reward a million times because it's the foundation of how I trade. And now we have to figure out how to identify and throw this back into what we're looking at. And I think this week specifically was a great example. Now, obviously, this will go for any type of market in general, but sometimes we need to identify, are we looking at from a bearish thesis, a bullish thesis, or are we really simply looking at what the market's giving us? And I think the latter is the hardest one to identify for ourselves as traders. Now, if I look at the SPY, you might get a few answers here. You might say, okay, well, we might be making, a head and shoulders possibly here, even though the head isn't very high, but you might be forming a head and shoulders, and so you're reluctant to enter anything. You might say, well, you're making your theoretically higher lows, so you still look good, so you don't want to enter the downside, right? But I think the SPY doesn't give us the best answer here. Now, a few things we can identify are above the 200 SMA, but really we don't have enough there. But this is why the focus of my trading isn't necessarily the SPY. Even though I want to trade the SPY or trade an equity, I want to go to ES futures. This is where all my time is spent, okay? ES, this is what on TradingView, this is where you have to pay a little bit extra to get live data, but it is what it is. Now, I want to show you what we're looking at here. And so my focus is always the futures, specifically the Nasdaq and SPY. And if you're trading specifically tech names, some of the higher, they move a little bit more. Nvidia, AMD, Tesla. I'm not going to really say Apple because Apple's the biggest holding in SPY, but it's also in the Nasdaq as well. Google, etc. Like these are big tech names, right? Now, when we look at those, I've personally followed the Nasdaq more than I follow the ES, and I'm going to explain here in a second, and you're going to get a better understanding why. So over the past few days and weeks, fundamentally, I've been clouding my judgment of viewing the market from a bearish sense because we have a lot of bad things happening. Banks are defaulting, whatever it may be. This could be 2009 and we could have, the housing crisis, or it could be the dot-com bubble in 2000. We're still having bad information being released, right? So it'll go for any type of market. But a few things that we can look here is this yellow line is our 200 daily moving average. Okay, that's what it is. It's one of the best trend finders that there is. The daily moving average and the weekly moving average for the 200. Very, very great indicator for understanding where you are on a trend. Now, we can see we mounted above this beginning of February. We pushed back below, and then we kind of held this area. But we didn't see a lot of good movement happening here. Now, what's important to understand is that you may have a thesis or may have a background view of what's happening, but it could be clouding your judgment. So what do we want to understand about market structure? Simply put, if you're moving in a bullish sense on higher timeframes between the 4 and 1 day, those are the beginning of the higher timeframes. Weekly, monthly, obviously get more as well. If you're moving in a structure like this, you can consider this a bear flag all you want. And I do sometimes consider it that. But I have to take what it's giving me and what the information it's telling me. Because if we're moving like this, this is inherently bullish, right? Because what's happening here? Right? You're moving and you're making higher lows and higher highs. Okay. So that's what you're doing. inherently, like we mentioned in the beginning with market structure. So this is going to be bullish all day long, no matter what's happening, until you break and make a lower low. So if you came back down and you made a lower low, then you'd be bearish, right? That'd be a structure break happening there. So we need to identify that. I'm going somewhere with this so you can have a better understanding. So when we're really getting a viewpoint of what's happening here, that's what we're looking at. And the same thing goes for making lower lows and lower highs, right? It's the same thing. So if we look here, what are we doing here on specifically ES, right? You're a little bit lackluster, but you're still nonetheless on higher time frames. Every pivot, right? You're making higher lows. So you push up, pivot, higher low. Push up, pivot, higher low. Push up, pivot, higher low. Okay, so you're getting the structure that you want, but it's not as aggressive. And this is where things get interesting, because we go over to the Nasdaq and what happens here. So we go into the Nasdaq, and this is, you can already tell this is a much better looking chart than ES, right? So you can see, yeah, we're making higher lows, but you're making much better and more aggressive higher highs than compared to ES. You can go look at the charts to compare to get a better viewpoint of that, but that's what you're doing here. Now, what I want to underline and tell you here is something that's very important here as well. So specifically, if your focus is trading equities, right? Tech names, stocks, whatever you're looking at, right? If I'm looking at tech stocks, specifically the mega caps, the ones a lot of people day trade the most because they have the most volume, I want to focus on the Nasdaq here. And the answer to that is, if you look back, for instance, we go back to our big rallies that we had. Specifically, let's go back to the COVID crash, and then we popped back up all the way into into 2021, right? Compare this move, right? Well, this massive move right there. Let's compare it really quick to ES, right? Nonetheless, still a great move here. You moved up roughly from 2,200 up to 48. So roughly like 140%. Going into Nasdaq, giving you a viewpoint here, you moved up from 65, 66, all the way up to around 17. So it's a little bit more, better movement there. But when we look at the tech names specifically, they're following and tracking the Nasdaq much more, and they're getting better movement. In comparison, SPY's, it has tech names in it, but it's going to have a lot less as far as like bank names too. It's going to have oil and gas names in it as well. It's a little bit more diversified. Nasdaq's primarily that tech, and that's where our focus has to be. And that's what I'm interested in. But the big part here, and is if you go and backtrack information, backtrack data, is these heavy markets have been led by the Nasdaq in comparison to being led by the ES. Okay, so that's something that we need to understand here. And actually, I'm so sorry, right? This is almost actually a 200% move, because you went from 65 all the way up to like 17. So it's much larger of a move. I'm so sorry. Anyways, it's a bigger move. So that's what we need to understand there. And so when we look at the action that's happening recently, and an error that I've been making is I've kind of gotten away from focusing on where I make all my money. It's focusing on tech names, focusing on the real market movers, right? The Nasdaq. And if we look here, market structure has been beautiful, right? Beautiful. Almost a perfect double bottom. You break, really the long should have been right here when you broke above 12.5. That was a long opportunity. But let's go back and look at what happened and what we said, the definition of what we look for on market structure. And if you're in Discord, you may have already seen this, because this is like something that we made way back when. But what are we looking for there? Higher highs, higher lows, right? That's what we're looking at. But then we kind of miss something. Double bottoms, double tops, new and old pivot highs and swing lows, being invalidated, right? And as we can look here, look what's happening. Where do we come back and find this double bottom? It's kind of coincidental as well. And this is just to show that even someone that trades all day, and this is where they make their money, make their living, even I can miss something, right? And that's the whole point of this channel, is to be transparent with you, the viewer, is to constantly show you that even I am missing things and learning things as well. And so when we come back here, look at kind of where you're getting that bounce. Right here near that major level, right? And I would come back and draw a little bit more right here as well. This is where we're bouncing at, right? Where you're finding that double bottom and you're holding that 200 SMA as well. Showing you're holding those previous pivot levels as well. So I talk about this and focus on this because it's important to find our levels as well, right? So where we're breaking out, where we're getting continuation. It's previous swing pivot highs, right? Right here. Double, kind of get a double top, push down, invalidate it, push back up, top, mount, Easy run, 400 points, right? This is what we've been talking about in our videos. If you start to break and hold, you get the continuation, you start to trade it back to the upside, right? Just finding these key levels and these pivot points. It's all there for you. So you understand the ranges to trade and how to make your money there. But what are the underlying factors of some of these equities that are moving through this structure as well, right? So we go to NVIDIA, right? Let's look at what's happening here. NVIDIA, it's honestly kind of unfair because it's the best name. I feel like I'm like cherry picking, so we'll go to something else. I don't even want to look at NVIDIA because it's just the strongest name in like tech that there is. We'll go to something as far as Adobe. Okay, Adobe. Tech name. Now Adobe kind of had that double bottom with the Nasdaq. And what's happening? You're very much so following the Nasdaq's movement here. Getting very good movement following it as well. Even though ES was getting some choppy days here, Adobe continued to move, right? Following that market structure. And this is the importance and the significance of following indexes over following your equity, because your equity may give you some sell signs, it may give you some worrisome, things happening in that time, but ultimately the structure of the market and the indexes are going to guide you and tell you how to trade. Right? If the indexes and the Nasdaq specifically has an illiquid zone up from 13.5 up to 13.7, high possibility you get that 300-point move because buyers have already broken you through that level, right? So same thing here with Adobe. Now, what we're looking for here, if you're trying to get a buy signal, is can you mount above 396? You get above this level, you're pretty illiquid all the way up to 425, and then most likely up to 440 as well, right? That's where I would start targeting, right? And this is just one of the tech names, right? Just showing you one of the tech names a little bit deeper. We can go, I don't want to go into semiconductors because they're just so strong, right? Microsoft right now, great overall viewpoint looking here as well. Getting rid of some of these levels here. Again, you're going to notice a trend following the indexes, very similar structure, double bottoms, double tops. It's following. This is why we harp and this is why we focus so much on these indexes, right? Because they usually guide us and tell us how to trade. Now, Microsoft, you're breaking out even better than the Nasdaq right here, right? You're coming right into your key level as well, right back in that 294, 295 range, right? Double bottom, very similar, a little bit actually better than the Nasdaq, but still double bottoming, mounting the 200, pushing up. Remember, this is the NQ chart, people. This is the chart here. Very similar. This is why we follow. This is why we're patient, right? And so you hear me often talk about patience, sit on your hands, this and that, right? This is where we're focusing on sitting on our hands and practicing that patience. When we're at these massive levels up here, right? That's when we want to focus on that patience, right? Let me actually make that a little bit of a different color so you can see a little bit better. But you can see, why are you focusing on there? Because you trended at these are your previous swing highs you had about right here, and you're trending right below a key level. Just chopping. Once you mount, boom, you trade it to the upside. Very similar structure, right? That's all you're looking to do here, right? Same thing when you get back down into these levels, back down into this massive range on here. You don't want to trade down there. You want to trade the illiquid areas where it gets really easy and quick to trade so you can get in, get out, especially when the fundamentals aren't on your side. And before I let you out of here, I want to give you a few things to watch for when you're looking at these key levels. I always tell this to everyone I know. When it comes to trading, they're always saying, well, in the 3-minute, we look so good. My first question before I even look at the trade is, have you zoomed out? It's the number one tip I can give anyone. Look at the 4-hour, look at the 1 hour, look at the daily. Understand if there's any big levels coming up and give yourself a little bit of room to be wrong. Let's say the key level is, on SPY, 404.3. Well, I might give myself 30 points either way, 30 cents either way to be wrong, whatever it may be, because you might get a fake out, you might get, a trap, you might get a wick, whatever it may be. Understand some of your levels might be off your mark. I use boxes specifically. You always see me use boxes, ranges, zones along the line to give myself room so I do not invalidate or rejection or a bounce too quickly. I want to give myself room to be wrong. I don't think people in this space acknowledge being wrong enough, but you have to give yourself room for a little bit of failure or a little bit of human error. Okay. No matter what type of trader you are, you have to zoom out. The underlying trend is far more important than the current day's movement. If we're breaking out of a level, if we're making higher highs in a 4-hour structure, then on the 5-minute structure, I'm going to be looking to trade to the upside 90% of the time. Why? Because the trend is still moving higher. So that means I don't want to counter trade what's happening out there. I want to focus on where the underlying trend and structure is giving me. Just like with the Nasdaq, as you're making higher highs, you got to be patient. You have to get real confirmation before you can go short again. Right? That's what I've been harping on the past week and a half. I said I like the downside, but guess what? I couldn't take any trades because we weren't getting the setups. We got to look at past trends, past structures, and looking at previous moves from a stock or index, and what they will offer is great insight to a reaction for that stock in the future. So when I'm looking at what's happening right now, I'm also looking at what's happening with the volume on the correction that we had back in 2020, the correction that we had back in 2008. 2009. How did we recover from that? Now, we may not have the same fundamental thesis of what's happening back then, but I can tell you the technical structures tend to be relatively the same, especially when we look at who's buying, how they're buying, and how they're getting back in the market. So those are things we have to be looking at, and those are really little Easter eggs in there that are going to help you find structure and make money overall in this market. If you have questions, please comment down below. I would love to answer your questions every Saturday. Again, we're making videos just like this. So like, subscribe, do what you got to do. I'll see you tomorrow. Have a good one.